All right. Hello, everyone. Welcome to our workshop this evening. My name is Jonathan Colleton, and I'm one of the Alumni Engagement Officers here at UTSC. I'd like to welcome you to Financial Fitness, Making Your Money Work for You, which is supported by our U of T affinity partners, Manulife and TD Insurance. Now, before we get started, I'd like to go over a few details about this evening's event. I'll be moderating our panel discussion with our three wonderful experts here that I'll introduce in a few minutes. We have some prepared questions for them, but of course, we are interested in the questions that you might have for our panelists, and you can put those questions in the Q&A, where my colleague Tara will be monitoring and approving questions to send to me to ask of our panelists. While our panelists are all experts in their respective fields, and they will be able to speak to a range of financial topics, I do want to be clear that they are not your financial advisors, and they won't be able to speak to some of the specifics of anyone's individual financial portfolio today. But we encourage you to take what you learn from this seminar and speak to your own financial advisor about your investments. I'd like to also note that this discussion is being recorded and will be posted on the UTSC Development and Alumni Relations YouTube channel in the coming days. Now, lastly, before I introduce our panelists, many of you know that when the university runs events such as this, we do a land acknowledgement as part of the University of Toronto's plans to respond to the Truth Reconciliation Commission's report. Today, we're coming together on Zoom, which means that we are in a wide variety of locations. And some people might be nearby campus, some might be far away from campus. Personally, I'm here at UTSC, so I'd like to acknowledge the land on which the University of Toronto operates. For thousands of years, it has been the traditional land of the Huron-Wendat, the Seneca, and the Mississaugas of the Credit. Today, this meeting place is still the home to many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work on this land. Now, most of you are probably in Canada right now, but maybe not everyone. And if you are in Canada, you may or may not know the history of the land that you're on. And if you don't, I'd encourage you to look into it, because in the spirit of truth and reconciliation, we first must know the truth. Now, let's do an introduction to our panelists this evening. First off, Oriel is a financial consultant for IG Wealth Management. Oriel began her journey in the financial industry at the administrative level, then moved to an associate advisor after receiving her mutual funds license. She was determined to build a client base for herself and took the leap as an independent advisor, and has since completed her registered retirement consultant designation, working towards her certified financial planner designation. Oriel takes the responsibility of her role very seriously, but she also loves to bring fun and lightness to the inevitable stress that comes with talking about finances. We're very happy to have that perspective. Thank you for joining today, Oriel. Next up, we have Kam. Kam is a retiree of TD Bank. As her last role as VP and market leader, she oversaw the growth and operation of 23 retail branches. Prior to stepping into the executive position, Kam has obtained a designation of Chartered Financial Planner and Chartered Investment Manager, and has managed high net worth clients in the wealth and estate planning arm of the bank. With over 35 years of experience in the banking field, Kam is passionate in helping everyone finding a comfortable financial solution in different stages of life. Thank you for joining as well, Kam. And last, but of course not least, we have Sarah. Sarah provides a bit of a different kind of expertise that I think we will all benefit from learning from. Sarah has an honors Bachelor of Arts and a Master's of Management and Professional Accounting. She holds a CA and CPA designation and has worked in compliance at the Mutual Fund Dealers Association for more than 20 years before transitioning into the Office of the Investor in August of 2023. Thank you as well, Sarah, for joining us. Now, let's jump into some questions. And this first question, I'll direct it first to Kam, and then Oriel, I'd love to hear your take on it. Most people here are very likely familiar with a checking and a savings account, and may have direct deposit set up in their accounts. And we're going to assume that all of our attendees know that you need to bring in more money every month than you're spending each month. So let's work under the assumption that, however small, the number in everyone's bank account in this seminar is growing each month. Maybe not every single month, but over the course of a year, they are saving more money than they are spending. Would you say there's a specific level of savings where you would start to advise people to begin speaking with a professional about a savings investment plan?
Well, thank you, Jonathan, for that question. Absolutely, everybody start with the with a paycheck when they first think about deposits. And I would say that you should go and see an investment advisor or financial advisor when you get your first paycheck. You may know about savings, but do you know all of the intricacy of savings and the financial plan? Because when you go to see a financial advisor, not only they will advise you on how to handle more efficiently and effectively in a checking and savings account, they can also help you or guide you through setting up your financial goal, whether it's short term in buying a car or medium term buying a house or longer term for reinvestment or retirement. You need to have a plan. And seeing an investment advisor can help you set up a plan like that. And also, they can help you with budgeting, of course. As Jonathan alluded to earlier, you need to spend less than what you earn. But how much less? What is the budgeting? How can you be disciplined about budgeting? And that's something that a financial advisor can help you. And also building up a good savings habit, just like building up your physical health or mental health. You need to have the knowledge as well as a good habit in order to achieve your financial goal. So those are the things that financial advisor can help you. Of course, in this day and age, you have all sorts of tools online. You can do it on your own if you like. However, the benefit of seeing a financial advisor is they will provide you with a roadmap, and they can be there to review it with you periodically, so that whether you are on the plan or off track, they can remind you about it, and also they can rejig your plan for you if you are off the track. So that's the benefit of going to see a financial advisor when you first get your paycheck. Start on the right foot. That's the idea.
It's a great answer. Oriel, would you have anything to add to that?
Yeah, I mean, I definitely agree with Cam. That's exactly what I would say is as soon as you get your first paycheck, or, as soon as you think of it, there's no minimum requirement, I would say, to start. I would say start as soon as possible. So even if you're thinking of this, 10 years after your first paycheck, 20 years after, it's never really too late or too early to start, just start. And whether, it's intimidating to talk to an advisor or whatever the case may be, they are there to help you and guide you. So starting the conversation as soon as possible is what we'd advise.
Now, I remember early on when I first had an advisor suggest opening a TFSA, and I had no idea what that was. And their suggestion was $50 a month is even helpful. And TFSAs are kind of what my next question is about, or not specifically TFSAs, but TFSAs are just one of the many different savings accounts that have 4 letters in an acronym that provide a variety of different tools for people to invest in. And so I want to talk a little bit about what these different accounts are like and how do they differ. And then Sarah, I want to get your take on kind of the safety of these different types of accounts. So Oriel, I want to go back to you first. Tell me about some of the different accounts and where you would typically be advising people to store their investments.
Yeah, this industry is excellent at acronyms and sort of convoluted explanations for things. So I can understand the confusion with all of the different sort of acronyms with accounts. I would say in Canada, the 2 main accounts that we kind of talk about for everyone, all encompassing, are the RSP, so the Registered Retirement Savings Plan, and the TFSA, like you said, Jonathan, so the tax-free savings account. Why choose one over the other? Why would you choose both? All of those kind of questions are they're all kind of personal. So what are your goals? What are your long-term, short-term goals? The main difference between those two come down to taxation. So with an RSP, you're getting a tax deduction when you contribute to your RSP, but you're getting taxed when you withdraw from it. The TFSA, you're not getting any kind of deduction when you contribute to it, but you're also not receiving any kind of tax consequence when you withdraw from it. Everything in a TFSA grows tax-free as well. So you are getting a little bit more of that kind of safety cushion with the TFSA. You have a bit more freedom. So it depends on kind of what people's long-term goals are. There's things that are built into the different accounts as well. So with an RSP, there's a first home savings opportunity or a first home buyer's plan that's built into the RSP as well. So if you are looking to buy a first home, maybe the RSP makes more sense for you. So all this to say, it really depends on your goals, and it really depends on, what you're trying to establish with these accounts. So there's also all sorts of other additional accounts, but I just kind of wanted to touch on those two main ones that kind of apply to everyone.
Yeah. Cam, because, there's only kind of one definition for each account. What I am wondering about actually is, how have you, as someone who's been in the business for a long time, seen these things evolve over time? Are there accounts that used to exist that don't exist anymore? And I know I'm throwing a curveball at you because I didn't anticipate this question.
The RSP, really I mentioned earlier about the home buyer portion of the RSP. Actually, there's a new account that came up called the First Home Savings Account, FHSA, like the acronyms. And that's a really good tool as well. It's a brand new type of account since last year. And it's like an RSP, you can get tax deduction out of it. However, there's a lifetime contribution limit of only 40,000. And you can use that amount to put towards your home. So that's on top of your RSP limit. So it's really great for people who are in a high income bracket that they use up their RSP plan. Now they can, if they haven't bought their home yet, they can also buy into this FHSA. And the good thing about it also is, if you don't have the money to buy it now, you can just open up the account, and then next year you can use the contribution limit of the last year. So you can save up your contribution limit and do it one shot. If you in a commission sales, you come across a big commission in the coming year, you can open the account, not make the contribution, and next year do double next year. So this is something that has it just came on board late last year. That's something that I would add. I can't remember anything that was there before but no longer here. I think the federal government is doing better and better in helping first-time buyer to buy their home. So they're adding more accounts that is tax deductible, more beneficial.
Yeah, obviously very good then that we're doing something like this, because there are new types of accounts opening regularly. I know TFSA didn't used to be a thing, and now it is, and now there's this new account. So you've really got to kind of keep on top of these things, which is something that I suppose an advisor would be really helpful in supporting. Now, Sarah, all of these different types of accounts, every separate acronym that we've talked about, are they regulated differently? How safe are they? Would you say that any of them are sort of safer than another?
Well, I think Oriella and Cam gave a very good overview of those three types of accounts. So all three of those accounts that they just described are registered accounts. Now, when we talk about registered accounts, we mean they're registered with the government, the federal government. So in terms of safety of the accounts, there is some safety in that sense. But they are really just wrappers. When we talk about these accounts, I think sometimes people get confused and assume that the TFSAs or an RSP is an actual investment, when in fact it's not. So they're just really, like I said, they're like vehicles used to hold various types. You could have GICs in there, you could have mutual funds, you can have publicly traded stocks in there, you can have bonds. So really, it's the underlying investment really that you also have to pay attention to, and that's where sort of safety is really of concern.
Yeah, that's a great point. I've the comment you had about wrapped up makes a lot of sense. I've heard it described as kind of buckets before as well. And so, the various ways of describing that. We have a couple questions from our audience here related to some of what we were just discussing about. And the first one, very quickly, Cam, what was the name of the new account again that you mentioned?
It's called First Home Savings Account. It's the acronym of FHSA.
FHSA, perfect. We love acronyms at the university as well, so this is not odd territory for me to be in. I have another question, and I'll put this out to anybody who'd be interested in answering this. Are there any best practices that you would suggest for maintaining a TFSA account? Anyone want to take a stab at that?
Maintaining.
I mean, I guess, yeah, okay. So I'll give it a shot. Hopefully I'm interpreting the question properly. I would say it's probably the same thing that I would say with an RSP, which is just making sure that you are setting up automatic contributions in your investment accounts, whether that's, $25 a month, $50 a month, like you said, Jonathan, something you won't necessarily miss if you're starting out, basically, and just kind of creating that habit. So with any of the investment accounts, I would say the most important piece is creating that habit. I do have some folks that I've spoken with who would prefer to send in lump sums of money. With that comes some pros and cons as well. But yeah, I would say that the habit is the best piece.
I would totally concur with Aurelia about the savings plan, the savings habit. Actually, I want to give a quote from renowned U.S. Radio host Dave Ramsey. He had someone did $100 per month contribution from 25 years old to 65, 40 years in a monthly of $100 investment. Can you guess how much it will earn at the end for that $100 a month?
No, I'm not good at math.
At the rate of 7% return, which is like quite reasonable.
I don't want to guess, and I feel like our other experts would know the answer. So why don't we tell the audience?
Yeah, it's over 1.1 million. So you can see the savings habit really makes a big difference. And like $100 a month is less than a cup of coffee a day. But at the end, you can retire really rich.
That is a great point. It's something that I would be interested to hear all of your opinions on this. I think it's with the TFSA in particular, not over contributing is also very important because there is a limit on how much you're allowed to put in there. And I don't know the specifics, but I believe you're taxed an excess amount if you over contribute to TFSA, but I think also your RSP, and I'm sure some of the other accounts. Is that right?
That's correct.
Yeah.
Yep. There's
head nods all around.
Yeah. So you have to pay attention to your contribution limits for sure.
Great. All right. Another question, and since we're talking about these different types of savings accounts, another question for the audience that I think ties in pretty well is for someone who has just graduated and is looking at starting their first job, is there any specific type of account you would suggest? So I know there is often, a debate about TFSA first, RRSP first, maybe some of these other accounts. Oriel, why don't we start with you there? Was there one account that you would suggest as the first account?
Well, I'm fearful to say for sure because I haven't met this person. So, it takes meeting the person and understanding their goals and all that sort of stuff to really give a good answer. But what I would say instinctually is TFSA is kind of allowing you the most freedom. So it's the easiest account to open. It's the easiest account to kind of change if you need to. So it just allows you the most freedom. So it's a great place to start. It allows you to grow all of that investment tax-free. So, there's no consequence. And then if you do decide to open an RSP down the road and you want to transfer some of the TFSA growth over, that's totally an option as well. So the TFSA allows you to change your mind, basically. It's a great place to start.
Great. Any other thoughts from anyone else?
I think great advice from Aurelia.
Everyone's in agreement. Fantastic. So next question I have for you, in things like real estate, we hear location, location, location. That's what really matters. And in investing, I hear diversify, diversify, diversify. Help me understand what that really means. What is diversity in terms of investment? How do I achieve that? Kam, let's start with you on this one.
Well, diversity basically means do not put all your egg in one basket. So in terms of an investment portfolio, you put your investment into different asset class. And asset class like cash, and then stocks, and then bonds, and then real estate. Those are the general different classes. And then even within the stock and the bond portfolio, like in the bond portfolio, you want to diversify into some short-term and some long-term bond because they behave differently. And then stocks, obviously, they different type of stock behave differently, and also geographical location in different parts of the world, and currency, different currency. So there are many kind of investment that are different. So you don't want to put everything in just one bucket. You want to diversify, put in appropriate classes according to your risk tolerance and your own needs. But also be aware of over diversification. There is such thing as over diversification, because if you have diversified into too many different things, it nullifies the effect, because it will make the portfolio more neutral. So you won't be, I guess, achieving your investment objective or targets. So just basically, it means is be careful of putting things into different buckets, and but you do need to put into different buckets in order to nullify the risk.
Great. Oriel, anything to add to that? And then Sarah, I have a follow-up question for you related to that.
Sure.
I think Kam said it all. Just diversifying is the intention of mitigating risk. So yeah, that's kind of, she summed it up perfectly.
Great.
She did. I think I'd just add that essentially the only thing I think we didn't talk about there were sectors of the economy. So in other words, you wouldn't want to put all of your eggs in Kam's terminology into sort of one particular sector of the economy, like a particular, precious metals or energy stocks or something like that. So it applies in the same manner.
Great. And Sarah, my follow-up question for you regarding that is, of all those things that a person could invest in, who decides what everyone is allowed to invest in? Who decides what's available on the market for people to buy?
Well, ultimately, I mean, I think, in my view, the investors deciding. So in other words, investors, whether they're working with a financial advisor, so if they're working with somebody like Kam or Oriel, I mean, they're still authorizing Kam or Oriel or the financial advisor to make those trades on their behalf, right? If they're working on their own, doing their own investing, say through one of the platforms like a Questrade or something like that, they're making their own decisions there as well as to what they're investing in. There are certain platforms like portfolio managers. Portfolio managers are given by the investors, they're given authority to make trades, discretionary trades on the investor's behalf. So in that sense, like, if I'm understanding your question correctly, that portfolio manager would be making the trades without having to ask the investor's permission every time. But in every other respect, like in every other instance, the investors are really the ones making the choices there, or they should be.
Follow-up to that is, of all the things that are available, you mentioned Wealthsimple or Questrade, which is part of the next question I want to ask, and a question we got from the audience related to that as well. Of all the things that are listed on that app to buy, who is deciding that those are safe things for people to invest in?
Well, each time a security is issued. So when I say a security, really what we're talking about are bonds, stocks, mutual funds, exchange traded funds. Those are all securities. Those are all examples of securities. They have to go to the Securities Commissions in order to obtain permission to list either on exchange or to be able to offer their securities to the public. So that's essentially how that's decided. And then those firms sort of have an agreement with those companies to distribute their products.
Great. So there is a level of regulation involved, and we're not going to be able to go out and buy things that are bad investments if we're working with a company that is reputable, that is where you can purchase investments?
Absolutely, absolutely. So essentially, it's different levels of regulation. So there's the provincial securities commissions, and so they regulate, fund managers. They regulate exempt market dealers. They regulate the portfolio managers directly. And then we have CIRO, which is where I am employed. So CIRO is the Canadian Investment Regulatory Organization. And we regulate directly anyway, the mutual fund dealers and the investment dealers. And as well, we oversee market activity. So, and we report into the Securities Commission. So, there is absolutely quite a bit of regulation actually here.
Good. That is, I'm very happy to hear that, because nobody wants to put their money somewhere where it might not be, safe because no one else is paying attention. And that perhaps understanding all those rules and regulations or why having an advisor is a really good idea, because it's a lot for the kind of a person like me to just understand all of that and manage all of that on my own.
Right.
And that brings us to kind of the next question, which someone in the audience has asked about this. Wealthsimple, Questrade. I was thinking about this, that I'm going to be having dinner with my father soon. We're going to go watch the Leaf game, and I'm sure that there will be a commercial telling me to not invest like he does. And it'll be from either Wealthsimple or Questrade, saying that there's a new way to invest and that you don't need to pay these high fees. Oriel, can you talk to me about those platforms, and what would you say are the major differences between these self-investment apps, and correct me if I'm using the wrong terminology there, versus working with an advisor?
Yeah, it all sounds good, Jonathan. You're doing great. If you watched the Super Bowl, you saw Questrade everywhere. I was pretty shocked to see so much of it. But the main difference between a self-directed sort of platform like Wealthsimple or Questrade and working with an advisor, the things that they often say are the fees. Some folks like to take things into their own hands and kind of use it as a hobby. I have clients who kind of do both. They have their self-directed portfolio, and then they have their portfolio with an advisor. But the primary difference is advisors are doing this day in and day out. This is their profession. It's their job, their full-time job. So you're getting that kind of full-time management of your portfolio. You're also getting access to additional things often. So tax planning opportunities, financial planning opportunities, just kind of having that at your disposal, being able to create a plan for yourself. But the self-directed platforms with the lower fees, some things that need to be considered are your emotional investing tendencies. So do you feel confident that you'll be able to withstand any kind of fluctuations? Do you know enough about the products that you're investing in? It can be fun to watch, and you do sometimes get access to products that you wouldn't necessarily get with certain financial advisors. For example, I'm licensed with mutual funds. I can sell mutual funds, so I can't sell independent or individual stocks in bonds on their own. So that's just an example. Or Bitcoin. Bitcoin is another thing that people really like to use self-directed platforms for. But hopefully I answered the question. The fees are lower because you're getting less touch points, you're getting less management, you're getting less sort of additional features. But yeah, there's kind of pros and cons to both.
Yeah, great. Cam, would you add anything to that?
I think while lower fee is important, but also you have to take into consideration your personal situation. Like actually like myself, I do have the knowledge of investing, but now after retirement, my interest is somewhere else rather than investment. I have a lot of hobbies and I like learning. And so I would rather pay someone to get it done than have to look at it myself. So while it is important to lower fee, but you have to balance your interests. Even if you have the knowledge, you have to balance your interests. You have to balance the time that you want to spend in look after your portfolio, and also opportunity costs, right? Sometimes if you're in a self-employed business, you may spend the energy in developing your own business, and you may earn more money than looking after your investment. So sometimes you may be better off paying somebody else to look after your investment for you. So there are other considerations other than lowering fee and the knowledge. I think with this online, you can learn a lot of things online now, but it is something that you want to do. That's something that you want to take a look at and balance it off yourself.
Mm-hmm. And technically, anyone watching this is hopefully learning online. So, there are a lot of benefits to that. Sarah, are these companies, Questrade, Wealthsimple, regulated differently than, the major investment groups like IG Wealth Management or the banks, for example?
So yes and no. So the reason I say yes is everybody would be registered. So with a provincial securities commission, both in any of those, what we refer to as order execution only, those self-directed platforms, those platforms are registered with provincial securities commissions, and they're also members of CIRO, as well as any of the investment dealers and mutual fund dealers, right? So yes, but there are different expectations. So there would be certain rules that, for example, an order execution only firm like a Qtrade or a Questrade would not have to comply with, because the investor is making all those decisions themselves. So what we refer to as the suitability obligation would not be imposed on, for example, an order execution only firm, right? Because the investor is the one making the decisions, whereas at another firm that is a full service brokerage, for example, there would be the expectation of making recommendations that are what we refer to as suitable for those investors.
Great. We are getting a lot of questions from our chat here, which is fantastic. Hopefully we can get through them all. One question, and this kind of relies to a few things we've mentioned before. What advice would you give for a first-time home buyer? That's from an anonymous, someone who has remained anonymous when asking this question. I will throw that to the entire group. I know we've talked about some of the different savings accounts. So, what would you recommend? First-time home buyer.
I'll leave that for Oriel and Kim. Yeah.
Okay, so I have a few questions that kind of stem from that in terms of whether they've bought their first home or whether they're saving for their first home. But my best advice would be to go and talk to an advisor. Depending on your income and what kind of savings you have set aside already, being able to create a plan that's kind of structured for you is going to be the best option for you. So if you're going to kind of look into things, if you haven't, let's theoretically say they haven't bought the home yet, look into your RSP home buyers plan and look into the FHSA, the first home savings account, look into a TFSA. So look into all of those three options and talk to an advisor about what makes the most sense for you. It's really hard to answer that question without knowing anything about the individual. So I'm doing my best here, and hopefully I answered the question with some sort of something for you.
I think that's a very reasonable answer. Yeah. Another question that came in is actually great because it points out that every sort of level of financial literacy is entirely different. And there's some things we're saying that maybe we're not defining and other people aren't familiar with. So maybe Kim, if you could answer this one, can you define a mutual fund? What are some of the pros and cons? And what would you say? Is there any benefit to non-TFSA mutual funds compared to a TFSA mutual fund? I'll let you, take that one to start.
So the difference between the TFSA and the non-TFSA is one, it's you earn all the capital gain or interest in the TFSA tax-free. So that's the difference between the TFSA and non-TFSA. So a mutual fund is just a vehicle, as like I think Sarah earlier alluded to. It's just within the TFSA, you can have the GIC, you can have anything, and you have mutual fund, you can buy stocks or bonds. So mutual funds, it's basically pooling everybody's money together or a pool of money together, because if you have a small sum of money, You cannot just buy 1 or 2 shares, but you can buy as a unit of mutual fund. So for people who are just starting out, mutual fund is a great option for them, because things that they cannot go into with the small sum of money, they can with the mutual fund. So I think, simply put, mutual fund is it would be a ideal vehicle for people who doesn't have a large amount of investment that they can diversify into different type of stocks or bonds or asset class. So that I would say that's the pro. And of course, the con is the mutual fund fee, that you do pay management fee to do a mutual fund. But nowadays you can do ETF mutual fund, which is very low fee. So you can also go with that.
Great. We'll jump back into some of our prepared questions and then go back into some of the audience questions here. And Oriel, this one is directed at you based on some of what I know your expertise is when it comes to discussing money with people. Money is very logical. Money goes in, money goes out. And, you know, as we defined off the top, more has to come in than goes out for you to be saving money or be out of debt. But sometimes we as the individuals don't always act logically, and we want to spend more money than is reasonable for us. And I know you have experience working with people who suffer from emotional spending. Can you define what that is and talk about how you advise those people?
Yeah, definitely. So emotional spending, we are emotional beings to begin with. So we are placing an emotion basically on an inanimate tool. So if we can kind of redefine or try to understand our relationship with money as a tool or as an emotional entity, we can kind of establish how we're treating it. Really what we're trying to establish is, are we treating it as an enemy or are we treating it as a friend? And once we're able to kind of clarify what our relationship is with money, then we're able to move forward with a plan that makes sense for us. But you know, for everyone, there's an emotion attached to money. It's a significant part of our lives. It's a significant part of what we feel we're able to create freedom with or get the things that we want and need. It's a very sensitive topic, and it's a really vulnerable thing to talk about with people. So being able to get really clear on what that relationship means to you is probably the first step that needs to happen before you even start talking about opening investment accounts and creating a financial plan for yourself.
Great. Cam, Sarah, anyone want to add to that? Okay, great. It's great when one person covers the whole topic, and we can get on to more questions that way. Let's talk about being a business owner, because we've talked about some of the things that are specific to individuals. I believe all the savings accounts we've discussed are kind of for individuals. But when you're a business owner, I imagine things are a little bit different. There's different things you need to consider. And so, Cam, I want to start with you, and then if anybody else wants to pick it up, let's talk about business owners. Are there different things you would advise when it comes to someone who owns a business regarding either how they would separate their finances or different kind of savings or investment vehicles they might utilize?
I would, I think for the main thing about business owner is most of them, they won't have a company pension. So they can, first of all, start with thinking about setting up a private pension plan. Because if they have put all their, like a lot of the business owner, they put all their energy and resources into the business, they may not have something else after they retire. So they can think of the private pension plan. The other thing I can see a lot of business owner is the succession plan. They spend their lifetime energy in building up a very successful business, but sometimes it's hard to see that they don't have anybody to take over the business. So they need to build into the day-to-day work succession plan. What is going to happen if one day they want to sell the business? Do they have someone to take over? And sometimes also the business owner, if there's some accident happen to them, if they run into an accident or something, who is going to take over? Because sometimes a lot of the business owner, they self-operate and nobody else know how to take over the business. So this is another thing that they need to think about when they are business owners.
That's great. That's not even the kind of answer I was expecting when I asked that question. So it's really good to have experts who can speak to these things. Sarah, Oriel, anything either of you would add to that from your experience?
I'd say taxes are important when you're running your own business, definitely. So I won't get into it in too much detail. I think it's sort of beyond this session, but there's a number of different ways you can construct shall we say, the organization or the company. It may not even be a company, in terms of from a tax perspective. In other words, it depending on the situation, it can be, it can be a separate corporation, but there's other options as well.
Great. Oriel, anything else to add?
I don't think so. I think as keeping it a high level conversation, that all sounds great.
Great. Now, coming back to some of the questions from the audience here, we have a question about real estate. I often hear real estate people say to withdraw your savings or RRSPs and invest in a property, even if you yourself don't own your first home. Example, if you're renting or live with your family or your in-laws. What are your thoughts on this? I'll leave that to the general crowd here if anyone wants to take a stab at it.
I think I'll try. I am a believer in bricks and mortars. So I would agree with getting your feet wet into the real estate market, even if you don't live in it. You live at home, but you can buy a property and rent it out. And of course, it have to be within your means, and location is a really important factor. And having a good agent to look after your property and rent it out to someone who would not default is very important. Having said all that, I think the benefit of investing in a rental property is you can leverage your investment, because banks will lend at least half of the property to you. Then you can leverage that amount. And then the other thing is you have somebody else pay the mortgage for you. And you have like guaranteed income to support your mortgage. So even if you cannot, you don't have the need to live in it yourself, with the real estate market long term, you can look at the long term growth of real estate prices. It's not bad. And also with GTA, for example, or Ontario, most of the immigrants coming to Canada will come to Ontario. So the demand is certainly there. So personally, I would think it's a good idea.
Great. Moving along to our next question here. There's a couple different questions that I think really boil down to the same thing. And Oriel, you may be the most relevant person to answer this one. How do you get started? Where can you find a financial advisor? If someone has no idea where to start, what would you advise them?
Such a good question. You can go to a bank. So even just walking into a bank branch, there's advisors there. You can go to, like for us, IG Wealth has a brick and mortar location as well. So sometimes you can look up, if you have any kind of idea of who you want to work with in terms of institution, you can Google the institution, and there will usually be like a find an advisor in your area section. That should usually provide you with an email and a phone number. And that way you can start the conversation and see, what I would encourage you to do, especially if you're kind of starting out and you're looking for an advisor to work with, is to find a personality that works with you and that you trust. It's important to kind of shop around, which from my, whatever, we don't love, but we love to find the clients that work for us and the advisor that works for you. So shop around, find someone that aligns with your values and that you trust. But just start Googling. And if you don't want to Google, then bank branches have folks in there as well. So whatever works.
Great. Another question, and Sarah, this might be relevant to start with you here. What are your thoughts on robo trading? And perhaps for Oriel and Cam, would financial advisors look into that to help with planning for investors? So I guess, Sarah, my question is really, is there sort of regulation around robo trading? And perhaps we should define robo trading for anyone who's not familiar, because frankly, I know about it from an episode of The Simpsons from a long time ago that talked about it. So how about we start with regulation of robo trading, Sarah?
Well, it's a good question because I'm not entirely sure sort of what scenario I guess the individual is asking about, but in most cases, what people are referring to is a situation where often it's partially, and it could be with the help of an advisor, or it could be entirely online. An investor would fill out a questionnaire, and that advisor or that firm would be able to advise on a particular type of what we refer to as a model portfolio, or a portfolio set up for that individual investor based on the answers to sort of questions that were asked that are sort of standard, questions regarding that individual and what they're looking for, what their goals are, and that kind of thing, what their risk level is. So yeah, that's typically, I don't know if Oriel or Cam have anything to add in terms of a definition of a robo-advisor, but that's what I think of when I think of robo-advisor.
Yeah. Cam first, Oriel second. Anything to add to that?
Yeah, I think that's the definition. But when you go to a branch, which is still like, I think every corner really have one of the banks here. I think it's just as easy to go to see an advisor, because it's easy to tell them about your personal situation, because investing is very intricate. I personally don't believe just a computer program can really help you without any faults on investing.
Oriel?
Yeah, I think it comes back to that whole conversation of emotional investing and just the personal touch. So it depends on what you want out of your portfolio and what you want out of the relationship. So if you're looking for someone that you can kind of bounce ideas off of and have a conversation with and goal plan, build a financial plan, then the robo investor is probably not going to do that for you. But it is, it doesn't make it bad or wrong. It's just something that you need to consider.
Great. Now from robo investing to robo calling, but once a month I get a phone call telling me I owe the CRA money, and I have never gotten in trouble with the CRA. I don't owe them money. These are scam phone calls. Let's talk about financial scams. Sarah, maybe, from a regulation side, I'm curious of your experience with that, and then we'll go to Oriel and Cam, but tell me about some of the common financial scams you hear about and how people can avoid them.
Yeah, I mean, there's a lot. It's been busy lately on that front, I'll be honest. So yeah, there's a variety of them. Some of them are AI based, and some of them are not. I mean, there's so one that we see quite often as a regulator is impersonation scams. So they will impersonate, these scammers will impersonate advisors. They will impersonate firms. They will impersonate the regulators as well. Telling people either, or asking people to invest. Sometimes it's with crypto, sometimes it's not. Yeah, we hear stories every day. A couple of days ago, I was asked to sort of opine on, we work on investor alerts on, so every week almost I'm dealing with one of these. There's, aside from impersonation scams, we've seen a lot of what we refer to as romance scams, or impersonation, or sorry, pig butchering scams. And I'll sort of explain that in a second. So romance scams often, you'll receive a message through something like social media saying, I'd like to, get to know you or something. It'll be somebody of the opposite sex. Inevitably, they're quite attractive, and eventually they ask you to send them some money. It's either just straight currency or it's crypto. Yeah, so those are quite common these days as well. The other ones we've seen are AI scams. So in other words, scams where, and often again, they appear on social media. So it's, a celebrity who appears to be providing an opinion on a particular investment or investment scheme and telling people to invest in it. So we've seen ones with Elon Musk. I think we've seen ones with Justin Trudeau. We've seen other ones. We've seen actually CTV News, the actual footage being doctored to appear as though instead of warning people about an investment scam, it seems like they're sort of promoting it. So it's been, it's been busy, as I said.
Yeah, obviously, many out there, and we've only got about 4 or 5 minutes left, so I want to get through a few of the other questions from the audience. So I'm going to just call out specific people who I think can give us a great quick answer for some of these. We have a question from Laura, and I think Cam, this is related to something you mentioned. Short-term versus long-term bonds. What are the difference versus the benefits?
Well, short-term bonds basically have a maturity date within 5 years, and long-term bonds is much longer term. So the risk of longer-term bonds is much higher than the risk on the short term, because the interest rate can fluctuate, and you can never project how much interest rate will be in the future, right? So it is basically the idea. But it is, in this session, is too short a time to talk about it in detail. So if you're really interested in knowing the differences, I think, as Aurelia and myself said earlier, go to talk to someone who can give you more knowledge about that.
Great. Another question here, Aurelia, for you. How do fees work when it comes to financial advisors? And, if someone's looking for a financial advisor, what kind of fees should they be expecting? But also, what kind of accreditations, I think I said that right the first time, should they be looking for in a financial advisor?
It again depends on what your goals are. So with someone like myself, when it comes to okay, so let's talk about fees first. Let's take care of the fee conversation. So generally speaking, the fees, and I'll speak from a mutual fund perspective because that's what I sell. We have an advisory fee and an MER, which an MER is a management expense ratio. So that's basically a product specific fee. Whatever you're invested in has a specific MER associated with it. It's usually it's always a percentage of what your investment total is. And then there's, generally speaking, an advisory fee on top of that. That's what we call like an unbundled fee structure. Depending on, the institution and the series of fund that you're in, there's other fee structures as well, but that's kind of the way the industry is moving, or at least mutual fund industry. But hopefully that explains that. It's a percentage of your investment portfolio is the fee. And the second question, what are you kind of looking for in an advisor? It depends on what you want. So there's lots of different, again, acronyms when it comes to what someone is, trained in and qualified for. So if financial planning is something that you're looking for, the Chartered Financial Planner, Certified Financial Planner designation is a really good thing to look for. I'm trying to make this fast. What else do we want to say? Cam, do you have any other ideas?
There's an RFP too. There's an RFP designation as well as part of those three, I think, big financial planner designations.
Yeah, there's like the CIM, Certified Investment Manager. There's all sorts of different acronyms that people can have depending on the way that they go in their training and their their education. So ask the questions and then, find out what that specifically means and what they're qualified for, and see if that fits inside of whatever it is that you're looking to create for yourself.
Mm-hmm. Okay, great. One more question from the audience, and then we might go just a smidge over because I have one more question I really want to get to. So quickly from the audience, Sarah, since you were talking about sort of who regulates what and who can do what, can banks help with trading stocks?
Yes, I mean, I think when somebody walks into a bank, I mean, I think people think the bank is just the bank. The bank actually has various entities within it. So, in other words, I mean, probably Cam would be the best person to talk about TD, but they do have, they almost all have a mutual fund dealer arm. They have an investment dealer arm, so they can, so for example, TD has TD Water, who's the investment dealer, right? And they would be able to trade in publicly traded stocks, ETFs, and so on, right? And yeah, they all sell they all sell different things within the various arms, but so yeah, I mean, I think Cam could probably speak a little bit better about sort of the various entities within the banks, but yes, absolutely, the bank is not just the bank. I mean, it is the bank, but there's other arms of that organization that can help people if they want to trade publicly traded stocks. Yes.
Yeah,
Yeah.
absolutely, Sarah. Yes. TD has the wealth management arm, which they have they can do it for you. And also, like the retail branches, they can sell, like we sell mutual funds there, and we do it with you because we'll ask you what you like to do, get your agreement to do it. And then also the other spectrum is the discount brokerage, which is you do it yourself. So we have a full spectrum of investment vehicles and arms that satisfy your need. If you want to do it yourself, you do it with someone, or someone do it for you. Yes.
Great. Now, to get to the last question that I wanted to ask, this is something that came up when we were all kind of emailing back and forth, thinking about what are some of the topics we'd want to discuss today. And, it's occurred to us that by accident, we put together a panel with 3 different women who work in the financial sector. And last week was International Women's Day. And I imagine that if I was doing a panel like this in the not too distant future, it probably would not have happened, that there would be 3 women on the panel, not by accident anyway. And so I want to talk a little bit about kind of your experience as women working in this sector and how you've sort of seen that change over time. And I'm wondering also about, women taking control of their finances or their family's finances, because I think historically it was probably more of like a man's job, and particularly in Ontario. I can't speak to anywhere else, but Cam, as someone who's retired, who I imagine has the most years in the business out of everyone on this panel, I'd love to start with you and get your opinion on that.
Well, I think now women certainly have the ability and the knowledge to take on the investment job of the family. But it's a matter of interest whether she is interested in doing that. But certainly a lot more women is involved in controlling their own finances. And I think it is a good thing. And even if you don't do it on a day-to-day basis, you need to know what your family's finances are. You can delegate the day-to-day job to somebody else, but be control of your finances. And I know women nowadays can do it, and I've seen it in my field.
Great. Sarah, we'll go to you next.
Okay. I mean, yeah, I've really enjoyed the fact that women have really evolved in terms of getting more involved in both investing in home finances. And I think it was Fidelity that did a study not too long ago that basically showed that when women are investing, their results are actually maybe marginally better than men for whatever reason. I think it was like 0.4%. But, you know, in terms of amount, women are still investing in terms of dollars less than men. And they attribute that mostly to sort of gender wage gaps over the years. But yeah, it's interesting. It's interesting and it's exciting too for women. Yeah.
All right, Oriel, last comment to you on this.
Yeah, I would say statistically speaking, it's really encouraging to watch things sort of shift in terms of women and empowerment, becoming investors, and all that sort of stuff. I think the industry has a long way to go, as do a lot of things. Even from the perspective of someone working in the industry, it is incredible to see a panel of all women. I also was really impressed when I saw that. So it's really exciting to see these shifts starting to happen. And I do see lots of things on Instagram and on different ads for women in finance and educational things for women. So things are happening. Yeah, it's an exciting time. And I think there is a lot of opportunity to still move forward, but it's definitely getting better.
Right. Well, I know that talks about finances can sometimes not be so positive, so it's nice that we're able to end on such a positive topic. I hopefully we got to most, but maybe not all of the questions in the chat. We hope that everyone has gotten something really valuable from this webinar today. And Kam, Sarah, Oriel, thank you so much for joining us and sharing your expertise.
Thank you.
Thank you.